Hey, welcome back. With several dividend stocks paying a very attractive yield and interest rates inevitably having to be cut, I wanted to show you 3 of the higher yield stocks I've been buying over the past year. The general idea and why I'm so interested in dividend stocks in the past couple of years has to do with interest rates and the way the market reacts to them. Even today you can get as much as 5 or even 6% per year from US Treasuries, which are as risk-free as you can get. However, when the Fed begins cutting the rates, Treasuries will end up paying less and less until they get back to 1 or 2%. This would make dividend stocks much more attractive, increasing the price. But this isn't about us, it's about pension funds and all the big money that has the power to move the market. Now, a special category of dividend stocks are real estate investment trusts, which to qualify as a REIT have to pay at least 90% of the taxable income as dividends. With that in mind, let's have a look at 3 such companies today that I believe offer a unique risk and potential reward in the current market. To begin with Realty Income, this is probably among the most popular dividend stocks out there. They are a real estate investment trust with over 15,000 commercial real estate properties paying a 5.75% dividend on a monthly basis. They have close to 90% of the rent coming from industries that are relatively resilient to the economy. The potential, in my opinion, comes especially from the expansion in Europe and the whole snowball effect of such a business model. You know, in very simple terms, it's the classic get debt at 3-4% interest, invest in real estate for 8, 9, 10% or even more and pay the difference back as a dividend or reinvest it. They have a diversified high-quality portfolio of tenants, and that's very important because they don't depend on a handful of companies from the same industry. They are diversified from any point of view. We can see that the occupancy rate is well above the median even during a recession, so they are very stable. We see them developing in Europe as expected, and once the Fed starts cutting the rates, this should be even more intensive. There is a lot of potential and they already have some very good clients. I think I said this back when I first covered the Realty Income. The real estate should be very flexible. What today is a CVS pharmacy can be, for example, a data center in a decade from now, or a dental clinic, both of which being something that they are already stepping into. Plus, you know, it's good quality commercial real estate, so it's very likely to be useful for a very long time despite a shift towards e-commerce. Following a merger with another REIT for which they issued shares, they can produce an AFFO of around 2.8 billion. That's a ratio of around 16 to 17, so around a fair value for such a company. Even in such an environment, we can see very nice growth year over year. And this year, without a merger that's already complete, they see about 2 billion in acquisitions. So we can see that there is a clear focus on growth. They actually ramped up the investments in Europe lately. There are worries that with all the acquisitions, the asset quality would deteriorate, but if you look at the recent big merger, for example, they actually spun off some of the assets, so they aren't just buying whatever they can. And again, recently, they bought some properties from another company, not everything they had, even if Realty Income had the money for it. And you know, with the focus on Europe, there is so much good real estate out there that they can really afford to be picky. There is no need to be desperate. It's true that after getting a bit into vertical agriculture and several other industries, they might be spreading a bit too much into things that they don't know too well. But on the other hand, you can see this as the equivalent of the bets that companies like Apple, Alphabet and so on do. Who knows, maybe in a decade when that industry is more developed, they'll be the #1 landlord of vertical agriculture or data center properties. If they don't try it now and get some experience, they for sure won't be. I think that at such a price, this is a once-in-a-decade opportunity to get probably the most popular REIT on the planet at a very attractive yield. I'm 100% sure that once the treasuries pay you 1-2% again, this will not be traded at a 6% yield anymore. Regarding constantly issuing shares, this is a very popular way for this type of company to fund growth without having to issue debt. Even when adjusting for that, this has been a very successful investment. What's good about them is that they have a very strong investor sentiment and a lot of confidence, so they can reliably issue shares at a good price and fund all the investments or debt repayments and so on. This is a perfect example of when the stock actually benefits the company. With the total assets covering the total liabilities more than twice, this is traded close to equity value, so that's definitely interesting. The debt is well spread in the future and they can always refinance. 94% of it is at a fixed rate, so they don't have to worry about whatever the Fed is doing. So overall, very good financials for a REIT. Adding this for around $50, meaning a dividend of around 6%, is something that I've been doing for around half a year now. Again, a potential 40-50% recovery plus a very nice monthly dividend and potential to grow thanks to the expansion in Europe. Given the business model, profitability and financials, Realty Income should be a stable dividend payer in the long term with a decent potential to grow. Overall, I think this is definitely still a very attractive price. Now, Omega Healthcare Investors, this is a real estate investment trust that I've been buying since a couple of years ago. They have over 800 properties operated by close to 70 tenants, being the largest REIT focused on skilled nursing facilities. They work through triple net leases, which provide more security at a low cost for Omega. Even with some obvious tenant issues due to the pandemic, the number one tenant operates only 11% of the assets, so they are very diversified from this point of view. The idea behind it is very simple. The number of baby boomers retiring should increase a lot in the near future, meaning that facilities like Omega's should benefit as well. It's actually a very significant increase that will affect many industries, so it's definitely not something to ignore. They even see the demand being above the current supply from 2030, so there might be a lot of interest and money coming to the industry in the near future. The occupancy rate is somewhere around 80% now, so even without investing, there is potential to see improvements, especially for the tenants. The AFFO has been relatively stable at around 700 million per year since 2016, which is impressive given the fact that this is probably one of the most affected industries by the pandemic. We see the jump in 2016 thanks to some big investments a year before, and overall they seem to be pretty careful with how they spend the money. They see AFFO of around 2.7 to 2.8 per share this year, meaning a price to AFFO ratio of around 11, so not terrible. And given the opportunity mentioned before and how big and still fragmented the market is, they expect to double in size in the next decade. Plus, there is always potential for global expansion since they are present only in the US and UK. I think that given the current state of the healthcare market, they might take advantage of lower interest rates when they come to expand again like they did a decade ago. This is a common business model for a REIT. Financially, they are doing fine, with roughly 8.5 billion in assets without the goodwill covering the total liabilities pretty well. And very importantly, 99% of the debt is fixed, so unless they want to refinance, high interest rates don't affect them directly. They still affect the tenants, to be clear. Overall, the financials shouldn't be an issue, and given the tenant diversification, they should be relatively stable. So, a similar potential recovery to Realty Income, but close to a 9% dividend, although a bit riskier, but not the worst. The debt is well spread in the future and no year should be an issue, and overall they are in a good financial shape. The AFFO, despite tenant issues and the crisis in the healthcare industry, has been very solid even through the pandemic, so this has been a surprisingly stable investment so far. Plus, they give direct exposure to an inevitable phenomenon, so I think this is pretty interesting. Like all the companies in the video, they should benefit when the Fed is done cutting the rates, so there are short, medium and long-term catalysts. Now, Medical Properties Trust or MPW, this is a very popular REIT for all the wrong reasons. They have over 400 hospitals in 9 countries, being the second largest non-governmental owner of hospitals on the planet. There is a massive amount of shorting, negative news, reports and so on, but in my opinion they aren't as bad as people think, and there is potential for a very nice opportunity. Even with a very unfriendly environment, they can manage to produce around $500 million to even more than 700 million, which is great for a 2.7 billion market cap. After cutting it in half, the dividend is currently at a yield of around 13%, which is after they went up quite a lot lately. They have triple net and absolute net leases, reducing the risk and the cost for MPW. This can be an issue when the tenants run into trouble, however, as they did because of the pandemic. And that's a very important aspect that the market doesn't seem to realize. I think I said this like 20 times, but MPW owns the real estate, so if a tenant goes bankrupt, all they have to do is find a replacement. At most, they lose unpaid rent, investments in the tenants, loans and so on, but even some of that can be recovered. They have 18.3 billion in total assets, which is well above the 10.7 billion in total liabilities. So even after a significant increase, the market cap is less than half of the equity, but the debt structure is also very important. By the time you watch this, the balance sheet is going to be different, but the idea remains the same. On the screen you can see MPW's upcoming debt. So 2023, 24 and now 25 are already covered, and if they focus on selling another 2-3 billion next year and refinance the rest, that's basically it. I'm not saying this isn't risky, but I feel like the market is overreacting way too much and is ignoring the fundamentals and all the improvements. In time, they've been reducing the exposure to the number one tenant, Steward, which currently has some trouble and is in a restructuring process. This is probably one of the most influential factors that was behind MPW's crash. But after a bunch of issues with the tenants and worries about the debt, MPW has recently announced some positive news. This is about them and the number one tenant managing to sell some assets, providing some much needed liquidity. If you're interested, I talked about MPW in more detail in several videos, including a recent one about the news. So they are on track to achieve and even beat the 2 billion target in asset sales, which covers a good amount of the debt that was behind the crash. If they do that again next year and refinance a bit, that's enough to stabilize and the debt issue would basically be over. Again, I think the market really exaggerated all these issues, but that creates opportunities. Now, this is riskier than Realty Income and Omega, but the upside is also massive, especially when you consider that there is potential for a huge short squeeze if everything is okay. It isn't over and this can still crash significantly, but it's a matter of risk and reward. For me, this has been a very good buy at anything below 5, 6, maybe even 8. I remain confident and all the recent developments reinforce my initial thesis. All three come with a unique risk and reward potential and should benefit from rate cuts. So overall they are all offering a very attractive yield. Even if the Fed doesn't cut the rates in 1, 2, 3 years, they should pay me enough to cover inflation and to have a constant amount to keep adding at a good price. Again, this might be a once in a decade opportunity because we don't see such market conditions too often. I think it's a no-brainer that they will go up once the rates go down, and I'm definitely going to take advantage of it. There are other companies that I'm buying, but this offers some of the most attractive yields. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.